In 2021, ProPublica analyzed IRS data and found a significant disparity. Jeff Bezos paid a 1.1% true tax rate. Elon Musk, 3.27%. Warren Buffett, less than 0.1%. Meanwhile, if you earn $50,000 a year, you likely pay an effective rate around 22%. How is this mathematically possible? Here is the mechanism most people misunderstand. The wealthy are rarely dodging taxes illegally. They aren't hiding cash in briefcases or running from the IRS. What they are doing is fully compliant with the law. They are utilizing a system written to prioritize specific types of economic activity. Let's define the terms. There is a functional difference between tax avoidance and tax evasion. Tax evasion is illegal. It is hiding income, falsifying records, or lying about what you owe. This leads to fines and prison time. Tax avoidance is legal. It is using the tax code to minimize liability. The confusion arises because the scale is different. When a billionaire pays near zero tax, it looks like a crime. In reality, they employ teams of accountants to utilize every provision in the 70,000-page tax code. Think of it this way. When you contribute to a 401k, you are practicing tax avoidance. You are using a legal provision to lower your bill. The wealthy simply have access to provisions that are not available to wage earners. Your heirs can sell the stock tax-free to pay off the loan and keep the difference. Here is the mechanics of it. You own $100 million in Amazon stock that you bought for $1 million. If you sell that stock, you trigger a taxable event on $99 million of profit. At a 20% capital gains rate, you would owe roughly $20 million. So, you do not sell. Instead, you borrow against the asset. Banks will loan $50 million using the stock as collateral at low interest rates. Loan proceeds are not taxable income. They are debt. You now have $50 million in liquid cash and have triggered zero tax liability. When you die, a provision called stepped-up basis kicks in. Strategy 2. Qualified Small Business Stock, QSBS. Section 1202 of the tax code allows investors to exclude up to $10 million in gains from federal taxes. If you invest in a qualified small business, defined as having under $50 million in assets, and hold for 5 years, your exit is tax-free up to that limit. This was designed to incentivize startup funding. In practice, it means an early investor in a company like Uber or Airbnb can cash out $10 million in profit and pay $0 in federal tax. Strategy 3. Opportunity Zones. Created in the 2017 tax bill, this provision allows capital gains to be invested in economically distressed areas. If you hold that investment for 10 years, any appreciation on that new investment is permanently tax-free. Example. You sell stock for a $10 million profit. Instead of paying tax, you move that money into an Opportunity Zone real estate fund. If that investment triples to $30 million over a decade, the $20 million in profit is tax-free. Strategy 4. Real estate depreciation. Real estate allows for paper losses that offset actual income. The IRS assumes buildings lose value, depreciate, over 27.5 years. This allows owners to deduct a portion of the property's value annually against their income. You might buy a $5 million building that generates $400,000 in rent. However, after deducting expenses and depreciation, your tax return may show a loss, even though the building put cash in your pocket and increased in market value. When selling, a 1031 exchange allows you to roll all proceeds into a new property, deferring the tax indefinitely. Strategy 5. Charitable donations. Philanthropy also serves as a tax planning tool. If you donate cash, you get a standard deduction. But if you donate appreciated stock, you deduct the current market value without ever paying tax on the growth. By donating $100 million in stock that was purchased for $10 million, A billionaire avoids capital gains tax on the $90 million growth and receives a $100 million tax deduction to offset other income. The system is functioning exactly as designed. It simply treats asset growth differently than paycheck income. In that period, Jeff Bezos' wealth grew by $99 billion. He reported $4.22 billion in taxable income and paid $973 million in tax. While $973 million is a large sum, it represents less than 1% of his actual wealth accumulation. In contrast, a household earning $70,000 pays roughly 14% in federal taxes. The distinction is how the code treats labor versus capital. Labor, work, taxed at ordinary income rates, up to 37%. Capital, assets, taxed at capital gains rates, max 20%. As demonstrated, strategic planning can often reduce that 20% to effectively 0%. Note: these are strategies accessible to average earners. While the buy, borrow, die strategy requires millions, there are provisions available to W-2 earners. HSA, Health Savings Account. This is the most tax-efficient vehicle in the code. Contributions are tax-deductible, growth is tax-free, and spending on medical needs is tax-free. Max-out pre-tax accounts. Traditional 401ks and IRAs lower your taxable income today. For 2025, you can shelter up to $23,000 in a 401k. Tax loss harvesting. If you have investments that are down, you can sell them to realize a loss, which offsets other capital gains and up to $3,000 of ordinary income. This breakdown isn't about judgment, it is about mechanics. Most wealthy individuals are compliant with the law. The result, however, is a tax burden that falls disproportionately on labor rather than accumulated wealth. What are your thoughts on the distinction between labor tax and capital tax? Let me know in the comments. If you found this valuable, smash that like button, subscribe for more content like this, and hit the bell so YouTube actually shows you my next video. If you want to understand the consequences of other financial systems, check out this video next. Thanks for watching.